Good afternoon. Happy Friday. This is Sean LaBelle of the Decker Hewitt Group. It was a negative week here for global equities as we did breach those June lows that we'd seen earlier in the summer. There was nothing in particular moving markets lower. Rather, it was just follow through from the commentary surrounding U.S. Federal Reserve and their hawkish outlook that we saw 2 weeks ago. As I said, we did breach those June lows. So now North American benchmarks are down between 15 and 35% on the year. The worst of which is, of course, the NASDAQ, which is bearing the brunt of the sell-off, given that those are the high growth names, the ones that are really sensitive to rising interest rates. So this week's Market Watch Weekly is also our Q3 recap. So it's going to be a little bit longer than usual. It just discusses the possible idea that we are going to see a recession now sometime in 2023. A lot of the technical indicators suggest this is going to be the case, along with some of the fundamental data is now backing it up. It's important to remember that the stock market is a forward-looking mechanism. It's always looking 6 to 9 months in advance. So the stock market will generally bottom before you see an actual technical recession occur. It also means that stocks will perform poorly while the broader economy is doing well, what we're seeing right now. It does also mean the inverse of that the stock market can perform better when the broader economy is deteriorating dramatically. So there's an interesting chart in this week's Market Watch Weekly that just looks at the historical returns of bear markets. Bear markets are obviously not pleasant. We are in one. We've been in one for now almost 10 months. Historically, bear markets last around 11.4 months with the average drawdown of around 35%. As I mentioned earlier, we're down between 15 and 33, roughly, depending on the index that you'd look at. And this is the positive side, is that, of course, bull markets generally last a lot longer. They average around 4.5 years with a cumulative return around 155%. So this is just to reassure investors that while we've obviously seen a considerable pullback this year, we do believe a brunt of the selling has been done. The heavy lifting of the central banks around the world has largely been in place. We will continue to see a few rate hikes here in the near future, but we're not going to see the same sort of magnitude that we've witnessed the last 6 months, which is, again, the reason why we've seen so much volatility in the market. Looking out into Q4 and Q1 of next year, we do expect to see some sort of calming environment in terms of the market volatility, because we do expect to start to see a bit of a pause with respect to these global central banks in their interest rate hikes. So we'll end it there. Hope everyone enjoys the weekend, and we will talk to you again next week.